We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome back to The Long-Term Investor. In this episode, I'm joined by Cameron Passmore, co-host of The Rational Reminder and leader at PWL Capital, for a discussion on why financial advice can get better with scale. And the conversation touches on so many great topics. We talk about fee transparency, advisor value, firm culture, private markets, AI, and most importantly, why the future of advice may depend less on better portfolios and more on better firms. As always, you can find detailed show notes at thelongterminvestor.com. And if you need any resources for how to interview a financial advisor, I have put a link at the top of the episode description. Just click on that. You can download it for free. And now, here's my conversation with Cameron Passmore. Cameron Passmore, welcome to The Long-Term Investor.
Thanks, Peter. Great to see you. You're a brother in the business, so it's super fun to be here.
Well, I can't believe that I'm only just now having you on the show. You've been instrumental in some of the ways that I think about interviewing guests as well as formatting the program. But we get the chance to run into each other in person a couple times a year. I think today I want to focus a little bit on the advice business because I think, a few weeks ago, actually, I did a podcast that said investment management is not a commodity. And let me just explain that I think there is a commoditized investment offering, but I also think there is a world where there's some customization, some personalization. And so, look, nothing wrong with the commoditized version. It kind of solves the investment problem. But I think you might agree, although please disagree if you'd like, that the advice business problem has not necessarily been solved. So I'm kind of curious, let's just start there. Once the portfolio problem is solved, what do you feel like the advisor's job is?
There's so much work that needs to happen to help people have successful financial outcomes. And I'm in Canada, which is largely dominated by the banking and insurance industry. More than 80% of long-term assets in Canada, we believe, are in the banking insurance complex somewhere. And while we're big fans of a strong banking sector for obvious reasons, when it comes to serving clients, there's ample evidence that outcomes are not that great in Canada. A bank branch cannot deliver the kind of service that many people need. And now with the help of AI and other weapons of mass due diligence, to coin a phrase from Prof G, more and more people are becoming aware of what a better service set can be. And scaled independent firms like ours are able to really focus on two main components of philosophies. One is markets work, and I know you and I agree on that. Markets largely work. Is that a commodity? You can debate the nuances of that, but markets, just embracing the notion that markets work and the great miracle of capital markets well over 100 years of data showing that markets do a pretty good job of figuring things out. When you combine that notion with the idea of planning matters, doing quality, customized financial planning matters, and has a huge impact and is so desperately needed by so many people. Bringing those two things together, and I can see some people saying, well, that's pretty straightforward. Markets work, indexing, and a financial planner, that should be a commodity. Well, if that is true, why isn't the marketplace completely awash in people with great, sensible, low-cost, diversified portfolios and a great financial plan? That is not the case in my country. Categorically not the case. We're still an industry largely driven by selling product. We're product obsessed. We're advisor compensation obsessed, right? And to deliver quality financial planning is hard, is complicated, takes a lot of people, is expensive to implement properly. And in this banking insurance complex, that is very, very hard to do. And I believe it's kind of a kamikaze mission for the profit margin of the banks to actually embrace it. So that's my initial take. But there's so much great work, from proper goal setting to understanding client situation, understanding what they really want to do in life, what their goals are, what their family situation is. To put that all together and to consistently deliver a great financial planning experience to a family over a lifetime is a lot of work and a lot of relationship needed to do that properly, in my opinion.
It's interesting. You and I, well, let me go zoom out. PlanCorp and PWL, our two firms, are some of the founding firms of a group called the Global Association of Independent Advisors, or GAIA. And one of the things that's struck me over the years is some of what you're saying on how in Canada, it's banks pushing product. There's no financial plans. In this group, we have people from all over the world and all taking a similar approach to investments. But it's always been just so striking to me that the US is quite far out on the spectrum in terms of quite far advanced on the spectrum of adopting lower cost product, on adopting things that don't try to predict the future. And I think in the last decade, at least, so I've been working for about 2 decades. The last decade in the US has seen a major push in financial planning. Now, I think the biggest change for the US in the past, say, 5 years has been changes in fee preferences. And you sort of noted it earlier, and I'd love to hear more about what is coming in Canada as it pertains to fee transparency and how you think that might force advisors to get better.
So Canada has embraced fee transparency, and starting next year, I believe, full transparency on all products from the consumer right through to the manufacturer. So not just the fees that your advisor might charge if you happen to be in a fee-based relationship, which we are and you are, of course, for decades. Like we've been fee-based going back to the late 90s. So that disclosure is happening. But it's what is the cost of the product that's embedded in your portfolio? So that disclosure is coming out starting next year. So I've heard many cases, talking to many people, and I talk to an advisor or two somewhere in Canada pretty much every single day. So I get an interesting lens onto what's happening. And there are a lot of advisors in Canada that are now quickly trying to shed the old expensive product that may have paid them a trailer fee, some sort of split commission, and getting into lower cost product or linked notes or some other type of product that has a lower fee disclosure coming. Because you start showing people, like the average expense ratio in Canada in a typical bank environment, I understand is something around 2%. Some people argue it's higher, maybe a little bit lower, but it's meaningfully higher than where we are and where you are when you take all cost. So I think that will have an impact. And I think a lot of people will say, wow, I'm paying this amount of money, and there's not the offsetting service set, because so many people, and I was at a conference last week in Toronto and met a lot of people in the industry there. And for so many people, the value proposition is about some version of, I am smarter than the market. I can pick stocks, I can pick funds, I can, do tactical asset allocation that will justify my fee. Well, the evidence is pretty clear, and I know you embrace this. The evidence is pretty clear that that's not likely to happen, right? And it's quite likely to really not happen, and you could underperform. And there's plenty of evidence going through institutions and endowments, so-called smart money, that add in complexity. They're not delivering the results. So I think a lot of people are going to realize kind of the gig is up if, and this is a big if people are paying attention. Is the consumer getting smarter? Canada is so far behind. Like I was turned on to this whole fee-based idea, oddly enough, at a Fidelity Active Managers Conference in Boston in 1996, 30 years ago. And we thought the rush was on then to convert to fee-based. 30 years ago, Peter.
It's pretty wild.
It's wild, right? And so many people in this country are not fee-based. Currently, it's so cloudy, and who gets paid what and how much people are paying. And I think there's a whole cohort of people in Canada that just don't even know this is an issue, because people largely go to the banking system for advice, and they don't even know the independent channel exists, let alone large scale firms like us exist. And when you go to the independent channel, it's a mess, right? You've got everything under the sun in terms of service offerings. So I'm very sympathetic with the public. It's not easy to find out where you should go. So hopefully it will change with AI and other tools that I think hopefully will cause some change. We're starting to see that now, where more and more people are reaching out to us with better questions, understanding the power of markets, power of diversification, power of keeping costs under control, power of a good advisor. So we'll see how fast it'll change, but we are so far behind you, Peter. There's so many great offerings in the US for great financial advice that we just don't have here.
Well, first of all, I'm going to have some questions for you on AI. I think that's an interesting topic as it pertains to the value of advice and, how the consumer can make more informed choices. But one thing that sticks out to me is a little bit of people treating the fee like the lowest fee possible for an advisor is all that matters. And I think sometimes, I guess the way I think about it is that the fee is not the product. It's sort of the wrapper. Like what do you expect to get delivered for that fee? And so you have flat fee, like for a set dollar amount. You have discount AUM or assets under managed fees. But I know my listeners, a lot of people who take a lot of interest in investing content like that you create. I should have mentioned at the start, co-host of The Rational Reminder, although I guess in the read-in, we got some of that material. But, when you think about how advisors differentiate, are there places where you think that perhaps advisors, even with all the fee transparency, maybe overstate their value?
Listen, if someone can do this on their own, they should. So if you think you can buy, and there's great tools, for example, from BlackRock and Vanguard, these one decision ETF portfolios that do automatic rebalancing for 20, 30 basis points. If you can do that and hire a fee-only planner every few years, I think that's a great model for a lot of people. And you can cut costs dramatically.
I'm going to interrupt you. A lot of people, because the world is a big place, but I think that personally, too often people put themselves into that bucket and they don't really belong there. Like they have more complexity than that.
Absolutely. And that implementation is hard, right? As your numbers get bigger, to pull the trigger on doing a trade, even in a Vanguard diversified ETF, if the numbers get large enough, there's still risk. There's still bias from the news. It's well known that the more you pay attention to your portfolio, the more conservative people typically become because they become worried about the story of the day. Just look in the past year, the stories that have happened in the news that might cause you to not invest when you should have. I mean, as we're recording this, I believe the markets are at an all-time high. I would suggest if you read the news and didn't know what the markets are doing, you wouldn't necessarily guess that markets should be at an all-time high. It's really easy to ignore and do well if you're wired that way. And this is where, my co-host colleague, Ben, will say, the lowest information investors are often the best performing investors because they just don't look, they just invest and carry on with their lives. But if you're going to be a DIYer and pay attention to it, often the news will sway your decision and you likely have a lower performance because of it.
As I mentioned that the fee is probably the wrapper, less so in the product. Everyone has different value propositions. And even if there's the proverbial 1% of assets under management fee, like I'll just kind of use that as a blanket statement, what gets delivered for that fee has expanded so much over the years. Oh my
gosh, absolutely.
What's really interesting to me is when in the US, I originally out of college went to an RIA. Back then, the sales pitch that you would make to people is like, look, your broker's charging you all these fees, much like what's happening in Canada today. That's sort of what was happening for me in 2007. And then all of a sudden, there's an explosion of RIAs where people are sort of more entrepreneurial. Maybe you have a solo advisor practice or a practice that has 3 to 5 people, or if you're really successful, maybe 10 to 15. But you and I are at firms that have delivered financial advice at scale. And so even though prices have not gone down for the value of advice, what is expected for that price has expanded so dramatically. So I guess, you have some experience at PWL. I have some experience at PlanCorp that I can share on this background. But that solo advisor model or that smaller model, what are some of the things and challenges that those advisors have in terms of delivering advice for that same proverbial 1% of AUM?
Well, I can only speak to the experience we have had. So in the past year, we've welcomed several teams of 1 and 2 advisor shops. And what they say to me is, oh my gosh, I had no idea my life could be so much better, right? Because when you're running a smaller shop, so much of your time goes into running it, finding clients, figuring out the tech stack, dealing with rent or whatever else operationally is going on. So not all of your time is devoted to the craft of financial planning and advising clients. So by joining a scaled firm, they are now able to focus, and this was their goal, to focus on the craft of planning. They didn't want to be business operators. So if you want to be a business operator, that is different, and I get it. But if you want to focus on the craft of financial planning, to be with other advisors, and much like you, our team is one team, one set of clients, one philosophy, one service deliverable, right? So and everyone is here to help each other improve all the time. So we have very vibrant, chat groups and meeting groups to help make the planning and advisory service the best it can possibly be. And as you meet more people, you get more complicated cases. You want to run things by other people. You want to get people as backup. You want to have a consistent long-term service, regardless of who the advisor is, for the clients. Like I've had clients that have now transitioned from me to other people on the team. They're way more competent than I ever was. Our planning offering is so much better, and it gets better all the time with more and more great, competent people joining and becoming more and more credentialed. So you get this ecosystem of excellence that kind of breeds more and more excellence. And I know that's exactly what it's like at PlanCorp.
Yeah, we both have experience kind of sharing best practices, again, at this Global Association of Independent Advisors, or GAIA. And by the way, for those of you, whether you're watching on YouTube or Cheddar or listening on the podcast, I'll have links to all this stuff at thelongterminvestor.com. And you said something that really stood out to me, that, when you acquire a firm that has one or two advisors and maybe a support staff, the biggest thing is they don't realize they've been running their business so much, there just isn't as much time for due diligence, or on whether it's tools or tax law or investments. And maybe I'm going to be repeating. Actually, let me share a story. When I was 30 and I came to PlanCorp, I came with the book of business as an advisor. I was a CFP, was a CFA charter holder. I was running a Monte Carlo analysis for clients, previously, and I was making sure their taxes got done and their estate plan was in place and things were titled. But I remember getting to PlanCorp and saying, whoa, like the depth of knowledge and the depth of bench is just immense. And I quickly stopped being an advisor. And I would have told you when I went to PlanCorp, I was a good advisor. I suddenly realized when I looked around, oh my goodness, these people are really good advisors. Now, I had a lot of investment chops, that plays a role. But again, at risk of maybe repeating ourselves a little, are there things that you feel like a firm can do better than an individual advisor, or just a smaller group of individual advisors?
Well, one example we have is in Canada, the big decision, if you're incorporated, like a medical practice or something, and you start to have retained earnings inside the corporation, should you take a salary or a dividend? Should you set up an individual pension plan? So most people are aware of this decision point. But in our experience, most advice usually is some sort of rule of thumb. Oh, you got to pay dividends and avoid tax. Oh, you got to do this. It's actually quite complicated. So we had a listener to the podcast, Braden, who reached out to us, I think 6 years ago now, had a doctorate in mechanical engineering, I believe. Was a literal rocket scientist. But he wanted to make a difference in the investment world. So he actually joined us, chucked his career at Queen's University, and joined us as a programmer, mathematician, scientist to bring a level of analytics to some of the ideas that Ben was coming up with from his research. So he was able to apply math to that specific question about whether or not I should take a salary or a dividend. Should I set up an IPP? Incredibly complicated. And what they realized is that by putting both their brains and their technical skills together, they were able to mathematically answer a question that they tell me a normal human could not answer because it's just too complicated. And it's also case specific. So depending on what age you are, what your goals are, like do you want maximum income, maximum estate to the beneficiary? What is your goal, your age, your situation, your tax status, all these different components. So to come up with what is the optimal strategy for Peter, for Cameron, for Braden, for whoever, takes an algorithm. So as an example of a tool we built, yes, it's super nerdy. It's super wonky. I've been told that we're kind of nuts, but when you actually look at the math of it, the math of it matters materially. It's like, call me nerdy, but if the math matters, you kind of got to do it. So we've invested in people like Braden, who's a researcher on our team to do this kind of research. So now he goes through like a Pac-Man with Ben and comes up with ideas. Like one of Ben's most popular YouTube episodes was on rent versus buy a home. Well, Braden built a tool to help illustrate the math of rent versus buy. It doesn't say which was necessarily better for you and your family based on your personality, but it puts some math behind the decision, right? Ben did research on goal setting, a scientific way of articulating a better set of personal goals. Show it to Braden goes and builds a tool. So you're able to have this kind of algorithmic, mathematical, scientific mind that understands what Ben's saying, but puts it into a real life application. Well, we weren't at this kind of scale. We could never afford to invest in a Braden. And if we weren't one team with one philosophy, because most firms in Canada are what I call Franken firms. You got Peter that's got this philosophy. You've got Cameron's got that philosophy. You've got Braden's got that philosophy. Well, what you end up having is a bunch of micro firms that are under some sort of brand, but there's no common philosophy. So when you walk in the door, you're not really sure what you're sure what you're going to get from Peter, but Peter and Braden don't talk, so you're not getting any sort of synergies. Well, you come in here, whether you see Brady, Jacqueline, Phil, Jordan, doesn't matter who you see, you're getting a similar belief system philosophy. And it's all supported, of course, by the podcast and Ben's YouTube. And now it's supported by the technical tools that Braden is building. It's pretty cool and it's pretty powerful. So now we put these tools out in the wild that people can just go use for free to help them have a better experience no matter where they are, whether they're a client or not. We put them out there to help people make better decisions. And of course, when you put things out in the wild to help people, karma comes back and people come back and say, you know what, I looked at that tool on goal setting. It's kind of cool. I want to talk to an advisor. So of course it helps us help more people, which is good for our business. But we're just trying to make a difference in Canada. That's our goal. We just believe by doing hopefully good work and putting it out there, it's good for all of us. But that's, I think, the perfect example. And if you're on your own, you can't build it. You maybe with AI you can, but I'm not sure you could.
It's the people. It's interesting. Our CEO, Chris Kirchhoff, always talks about how, look, we want to be the destination for the country's best advisors. And to do that, you have to have the best team. And he uses this example in the 1990s when 2 TV shows came out. I can't remember what one of them was, but had like a really high-flying cast and a huge market budget. Then there was The Sopranos, and like one of them went on to be The Sopranos and the other one went on to be this thing that I can't even remember. And when you look not just at the actors, you look at the writers, you look at the cameramen, you look at the production team. It's similar like in sports. I'm a big baseball guy, and right now the Dodgers are just like the empire, and they have the best players on the field, but they also have the best staff. They have the best support. And, those advisors, a great advisor is worth their weight in gold. But when you have a team who can support them and give them more tools and make them the best version of themselves, which is sort of what you're describing, it's just something that a smaller firm can't really ever meet. The other thing that I thought that was interesting is you mentioned like the importance of one philosophy in getting synergy in philosophies. You mentioned in Canada that a lot of firms are Franken firms, as you put it. It's kind of that way in the US. And what's interesting about the RIA space is that you just get a lot of people who are breaking away from a wirehouse brokerage firm and just going into an RIA and kind of doing whatever they want. These mega firms that have a million different philosophies. Let me ask you this. So when you are looking at acquiring a firm, and you're trying to understand if they truly share your philosophy, what are non-negotiables when you're talking to a new advisor? And what are red flags that kind of come up during acquisitions? I'm kind of curious to hear your thinking on that.
So I'll set this up by saying my long-standing bugaboo with this industry is the advisor is the star, and pretty much everything's in service to the advisor. And the problem I have with that, and yes, that's how I came into the business 35 years ago or whatever, was about my own practice and my own outcome. But I like to think that I've learned and changed. But the power of having one team where the team is the star, the system is the star. The advisors, of course, are super important. They're delivering the product. The advisory team delivers a product to the clients. But they know when clients come in, they know they've heard the podcast, they may have seen the YouTube, they may have seen our articles that are put out by our marketing team. So you can tell we're all working together, right? You need a finance team, you need a compliance team, you need all these things in harmony to pull off what we all do. And I'd like to think that clients can see, right? But in terms of meeting potential new advisors, and again, I talked to so many people and so many people just, it's so obvious they won't fit, right? You got to be a real team player. If you believe the advisor is a star, you're not going to fit here. Like, it's just not. If you're not passionate about the craft of financial planning and bringing a level of professionalism that clients deserve, and I believe clients will become more and more aware of as time goes on, you're not going to be a fit. But if you think you're the star, you deserve to make the lion's share of the compensation, it's just not going to work. Of course, you have to believe in the investment philosophy. That is the quickest filter, especially in this country. Most people think we're wackadoodle. Seriously. They look at you like, oh, you just do index funds, you just do ETFs, right? Well, there's so much more to that. You know, Ben's up to episode 420 or something on looking into the science of investing, the academic field of decision-making and portfolio structure and implementation. It's incredibly complicated, even though, yes, it's a commodity, but to understand it has been an enormous amount of work to understand that. Well, that is worth something, but you have to believe in that, right? If you believe your value prop is in picking the next manager or rotation or market timing, it's just not going to fit, right? So people that join, it's pretty obvious they're going to be a good fit. You just know, right? When you meet them from a character standpoint, from a care standpoint, we think we have a certain level of, just to believe markets work takes a certain level of humility, right? To not think you're the smartest person in the room, right? There's a certain level of humility about that. But a good fit is just such an incredible thing. The teams that have joined are truly unbelievable and fit in here like they've been here forever. So but if you have to wonder if the answer is yes, then you know it's a no, right? It's not something you can force. And you guys are no different. Like, I know you and your colleagues pretty well. Like, you're very much like us, right?
You know what I find interesting? So you mentioned in Canada, you look like wackadoodles. You know, sometimes when I go to due diligence events, particularly events that are focused more on private investments, I realize that a evidence-based approach, a rules-based approach to investing is still not widely adopted. And if it is, it can be tactically so. It's sort of like, hey, I can use an index fund, but you could be quite active with it. But speaking of private markets, you know, that's a place in the US where access to the narrative, at least, is exploding. I'm kind of curious if you feel like this is an opportunity for clients, or is this an opportunity more for investment management firms to distribute?
You know my answer. So let me take the positive spin on this. A positive spin is markets work, right? And for the vast majority of Canadians that need to work with firms like ours, pick the number, portfolio size, somewhere, 500,000 to several million. That's kind of the right down the fairway of who we are trying to help, right? We're striving to get technology that we can help people with more modest means to start. But there's so many people in that lane that need good help. And I would argue, if you're in that lane, you do not need access to private markets. You may want it. Yeah, I guess there's a certain kind of flash appeal to it. A lot of evidence suggests that you're not going to outperform in Canada, and this might be the same in the US. So many advisors I talk to have some version of private asset or alternatives on their books that is now gated, which is the polite way of saying it's locked up. From who I'd speak to, it kind of sounds like a bit of an epidemic in Canada where so many assets are locked up. I've talked to clients, institutional clients that have had an unbelievable proportion of their portfolios locked up because they were just loaded on this stuff because everyone's got to follow the Yale model, right? I think there's evidence that suggests that a lot of those endowments are not outperforming. I know some of the largest pension funds in Canada aren't even keeping up with a simple Vanguard balanced portfolio. They're sophisticated. I get they're sophisticated, and I get we're, know-nothing ETF investors, but markets kind of work. They're kind of smart. And if you look at the Bessemer evidence, trying to beat the market, I'll take the case of give me the whole market. I'm not sure which of the pieces of hay in the haystack is going to outperform. Just give me the whole haystack. That's done pretty well over time, right? And I would argue you don't need private markets. I would argue most people don't get access to the private assets that they might want. And let's face it, if you're a great private investment, are you going to go to CalPERS or Canada Pension Plan or wherever to invest, to get the investment dollars? Or are you going to go down to the retail advisor in Ottawa, Canada? I would suggest you do it to the big guys first. Maybe I'm wrong, and I've heard the counter narrative, but also if you look at public markets, there's so much diversification that you can do to improve your returns over a basic index fund. And you and I are fans of this, the factor tilting and, a lot of the characteristics of some of the private investments can be captured by having smaller value type companies, more profitable companies. So until you've done all of that properly, maybe get all that in place before you start going on about private investments.
What's going to be tricky is when trusted brand names make it even easier to access private markets. Not to pick on Vanguard, but I will just for a second, talked about having target date funds include these private investments. They've since walked that back and said, well, there'll be a set of target date funds that will include these. And what I sort of worry about, and actually I've interviewed people from Vanguard on the show and explained this, that people see a trusted name like that and say, well, if they're offering it to us, it must be okay. Yeah. And what I think a lot of people miss the point on with privates in general is that so many of the facts that people use to sell them, they are true, but they're not all relevant. And so I think what's difficult for people sometimes to unpack is when someone sounds smart and is using facts, it's difficult to discern what is relevant, what's a relevant fact and what's an irrelevant fact. So like people will always point to, hey, there's less public companies than there used to be. You're like, well, that's true, but there was also like a huge boom of public companies, and these private companies, they are super micro caps. Like, people want to have access to certain things. I think what people underestimate is most of what you can get in private markets, you can get in public markets. Those private markets are micro caps and they're all very active management. Granted, you can go in and actually run the business, but it's off of a single thesis or set of theses. And it's a lot of the things that the most disciplined investor, the biggest student of investing, one who's embraced a lot of the science of investing, ultimately would say they're against. Where we ultimately land at Plan Corp, I'll kind of say where we do access them is, look, if you're overweight liquidity and you maybe have $20 million portfolio or more, and we can really align the why to the investment, to me, I start to have the conversation, and it can even be, look, I just want something a little more interesting. At least you're being honest about it. And I think if I were to win the lottery, Cameron, if you dropped $100 million of after-tax money into my checking account, chances are I would make investments in non-public securities. Now, would they be these same funds? I don't know, but I would invest in things that interest me, and you'd just be a very small part of my portfolio. But generally speaking, when clients approach us about private investments, we do sort of draw the line on what makes sense because, as you noted, many of these funds, even though it appears that they're more liquid, they get gated. They still are illiquid. So you have to be what I would call overweight liquidity. And you'd have to have a really firm understanding of the why you're doing it and not just drop you into a model set of private investments, but try to align it with your why. If there's some sort of thing you're trying to get at and you can really afford to do that. Meyer Statman once talked to me on the show about like wants and needs. And I was like, well, how do you think about a fiduciary duty with a want? And he's like, well, look, a want is okay. You can let somebody have a want if they can really afford it, that you're still being a fiduciary. Really roundabout. I mean, I'm kind of curious your thoughts on what I'm sharing, or if a client approaches you about privates, what are some of the things that you're sharing?
Hey, listen, I'm a fan of, my largest personal holding is private equity in the company that I work for, right? So I'm not opposed to private equity, but there's no fee on that carry, and that's part of, I have no issue with that. The issue is the fees and access. Now, if someone comes in, and we have some clients that are able to get access to certain private investments, we can help with that for sure. But to go and systematically bring it across the board to all clients as part of our value proposition, that's not something we do. We're down the fairway with the average Canadian is trying to save the money they need for the kind of economic future they want. And for the vast majority of those people, there's no need. It's hard enough just to behave and stick with the plan as it is, let alone adding in privates and the stories and everything else. And there's so much complexity. Even like our IRR gets thrown around, which is, that's another topic for another show. But there's so many facts that people just don't understand. So,
earlier on, you'd mentioned something about AI, kind of going back to the advice arena. How do you feel about AI and technology? Is it going to make high quality advice more accessible? Do you think it makes financial product distribution more efficient? Like, how do you feel like it helps or hurts the end investor? Let's just, wherever you want to go with that.
Yeah, so I think about it in two ways. One is the deterministic side, which is anything that's kind of what Braden was building, where there's certain facts that AI can help you build things better. So we're using, of course, AI, and I guess it's vibe coding, but do not take that like I'm an authority on this. And we've been doing this for years. AI helps us do it faster. We've been roaming around the firm, fixing all kinds of small issues, be it in compliance or wherever. We're using AI and tools. And it's deterministic, fact-based, get it done. That's helping on that. So that's just making things happen faster. So of course, we're all embracing it. On the distinctive side, which is how we deliver what we do to people, AI is certainly making advisors better. So like we've long had a data lake. So we have a clean source of truth of all of our data. So of course, by having a clean data lake and we have a data team, we're now able to unleash the power of AI in ways that we're just starting to realize what kind of intelligence you can get, right? So we're going to be able to soon query the database and say, okay, pick a number, last 100 meetings with incorporated physicians, what were the number 1, 2, and 3 topics that came up in those client meetings? Maybe Ben should do a podcast on that. Maybe we should do a white paper on that. Maybe we should do a training on something if the common questions coming up. We're going to be able to pick up on sentiment from advisor meetings. What's the common themes with clients? What's going on with, perhaps we can link feedback in client meetings to what the market's been doing. I'm just kind of brainstorming. But once you've got the data and the ideas, it's absolutely endless how this can improve what we do. It is absolutely going to make better advisors better. If I was not a good advisor, and I'm not sure how people even would realize that, like I've got a definition of that, but people are coming in more often so well prepared, saying like, understanding the market's work, diversification, costs. If you're not in a low-cost, diversified index-based portfolio, I'm not even sure what you answer to people like that. I guess you just go next and hope for another prospect to come through. But when people come through believing in that, but don't quite have all the pieces, because let's face it, you and I have been studying this for decades. It's not that easy. It's easy to us now. But if you're a consumer with all this noise, right, coming through with some information from a Claude search, to meet an advisor that can help you understand this and make better decisions, my God, the power of that is off the charts. And that's what our experience is now, literally every day with people coming through. We're getting more and more searches because people are searching differently. It used to be financial advisor near me. Now it's like, I'm an incorporated, oncologist in the province of Manitoba. How should I take my salary or dividends if I have this type of tax basis in my corporation? That's a very different prospect than financial advisor near me, right? So it helps us build content. They can answer these questions so these people can find us, because that's where our headspace is. And I'm not suggesting there's not other great advisors. There are. But as far as we can tell, there's no other in Canada scaled firm, markets work, planning matters, one team, one philosophy. There isn't another one, to our knowledge, in Canada. So we're working real hard to get in front of these kinds of people who are looking for this kind of help. Nerdy? Yes, it matters.
One, I feel like having watched PWL for, I don't know if it's been a decade now. I'll say 5 years conservatively, but maybe longer than that. I'm just thinking back to when Gaia started. I feel like your statement is a valid one. And in the US, the only firms who can make some of those investments in AI, like you speak of, like you're doing at PWL, are those with a scaled team. It kind of goes back to what you were talking about earlier, like when you have the people in place. And The data lake itself, I remember when we cleaned up our data and it was in the name of some marketing efforts to customize journeys. We didn't know at the time that AI was coming and it would be such an important thing, but it was a really big lift. And we had been in business at that time for over 30 years. When a new advisor or a firm that we're looking to acquire, like when we start looking at their systems, the data is not clean enough to leverage AI. And so I think there's probably a lot of the investing public who assumes that, all advisors are going to be able to leverage AI and give me a better experience. I don't think that's necessarily true yet. I'm sure it will be at one point in time. The other thing you kind of mentioned, though, is that the client comes in more educated. They have so much information with AI. I, like you, believe it's generally a good thing, but is there any place in all of this where you feel like more information can actually be harmful?
Well, more information is more noise. More noise can cause more bad behavior. So we've worked with, people from Shopify for a long time, and there's a certain profile of people in that technology realm where people go do a deep dive, get it, and move on to the next thing. And I don't know if it's a tech thing. I don't know if it's a Shopify thing, but I just use this as an example. The beauty of the philosophy that you and I share is once U.S. markets work, it kind of gets solved. So you don't have to keep searching and questioning. You just have to make sure you behave well, save the amount you have to, all your stuff's in order, your estate plan's done, your taxes are taken care of, and you're on track and keep revisiting it, right? Yes, your life will change. There'll be unintended things that happen in your life that you need advice for, but you don't need to continue to revisit. So I kind of worry that, and you look at what's happening with, the prediction markets becoming integrated into the investment platforms, and this kind of get this gambling even more so than some of the apps we're doing before. So I kind of worry that people are always on the hunt for like, where's my next quick buck, which is all such bad behavior. So bit of a fear there, but once you kind of realize, like, it's so liberating. This. It's like once you get it, oh my gosh, markets work. It is so liberating. Any sort of prediction, podcast, article, and it's because all that stuff happens that markets work. All these forecasts, like, why bother? It's in the prices. And if you just believe that, doesn't mean prices are always right. Doesn't mean the market can't go down, but it's likely to go down for reasons you didn't think of, right? And stay diversified. Gone through the crash of 99, gone through the great, the GFC of 08, the pandemic in 2020, like all these things have happened. And markets, companies are adaptive and they figured things out. That is such a liberating belief system. It's unbelievable, the power of that. Don't you find?
Oh, absolutely. I think what sometimes I find listeners of this show, for example, the listeners of this show, I'm just going to broadly say like a third of them are do-it-yourself investors, a third of them are clients or potential clients, and maybe a third of them are advisors, and then kind of roughly. And what I find that some advisors and some do-it-yourself investors hear when they hear that message is that it's easy. And I think one of the challenges and the good part of where advisor brings value is the answer is easy. The implementation is difficult, because to have that belief system, yes, you have to live through a 2020 or a financial crisis, a defined short period of time, but you also have to live through 10-year periods where markets are going up and everything seems fine, but there's a part of your portfolio that doesn't necessarily feel like it's right. And so the answer is easy, but we are behaviorally hardwired to make all sorts of terrible choices. I hope that something like AI, if someone's going to chat to AI rather than have an advisor, I hope that AI is trained on getting people to not change their investments. When you adopt a philosophy like you and I have, that the future can't be predicted and that the market is very, very good at setting prices, what that does mean sometimes, though, is that some things fall out of favor. Being globally diversified can at times, not just for a year or 5 years, but 10 years or 15 years can look really, really awful. The worst thing that I've ever seen Warren Buffett do for the investing public in the US was say that he's going to put his entire estate into the S&P 500 because those companies have half of their revenues overseas. All those statements are true. However, you have to, there are 3 extended periods going back to, I think it's going back to 1950, where anywhere between 12 and 17-year stretches where the S&P 500 lost to cash. And so we have a generation of investors here in the US who just put their money into an SPY or, equivalent like an S&P 500 fund and think it's easy. And you're going to get into a period where it's hard. And so like being a student of history, being a student of the market, if you're going to do it yourself, you really have to apply yourself to those things.
Plus the S&P 500 was never created to be an investment option.
100%. Yeah.
Right.
Is built to explain performance, measure results.
Explain performance. When you understand where performance comes from, you want to diversify to different sources, unique sources of expected return. And look at the last decade from 2000 to 2010 for the S&P 500. Had you diversified into those other factors, you would have had a very good investment experience. And I agree with you. That's my bugaboo with that message as well. Now, the positive message in that is costs matter. Diversification is your friend. Don't predict the future. So on balance, it helps, but it's just not quite far enough, in my opinion.
Well, why don't we put a bow on the conversation by hitting one more advisory topic? It's been a big focus of today's conversation. Let's fast forward 10 years. Cameron, tell me what you feel like a great advisory firm looks like and what might be different for the average client.
Honestly, I don't know what the technology will look like. I think people overswing on wanting to have fancy apps and whatnot. The number one complaint that we get from clients is that our tech is not as great as they would hope it would be because, Apple set the standard for great user interface. But I think there's ample evidence to suggest that seeing stuff more often fancier is not very helpful. So I don't personally get too fussed about technology. To me, it's all about the service, the quality of service. I think we'll still have advisors meeting people. Do I think there'll be fee pressure? I think there's always going to be fee pressure going forward. I do think AI does change the equation differently than the robo-advisors did. I was never particularly worried about robo-advisors, but this is different. I mean, robo-advisors proved even robots couldn't stay as robots in Canada. They had to come out with all kinds of other things like cash deposits and private equity and crypto under the guise of meet the clients where they are, which is complete nonsense. Number one question I think people should ask when they meet or interview an advisor, do you have a buffet or a belief system? Because if you've got whatever I think I want, you're a stock picker, I've got that. Or you're a dividend person, I've got that. I'm a crypto guy, I've got that. That's a buffet. No, buffet, don't take the buffet, take a belief system that makes sense. So I don't see the market's work philosophy changing. Do I think that advisory teams can scale? I think advisory teams can handle a lot more people, a proper diamond team for the advisors out there. They know what I'm talking about. A proper scaled team using AI to be able to help more people. I think we will be able to help more people. Does that drive the cost per unit of advice down? Probably. But we'll see. I still think, and people call me old-fashioned. I see a world where a lot of people will be able to get AI-enabled help, perhaps from some sort of chatbot. I get that, because there's always people that don't want to pay for advice. I get that. But there's so many people, my God, in Canada, 80% of the assets are in the banking system, like I told you. So many people just need reasonable help from good, honest people with a belief system that makes sense. It's a desert up here. It's unbelievable. So now maybe the banks are okay with us doing this because, let you guys do all the nerdy hard work, the low margin work. We're going to keep the people that are here because we only have half a dozen banks in Canada, by and large. So we'll see. People still read books after all these years. We're human. We're talking. I think people want to talk to people to have confidence in their decision. But I think the standards of what they're going to put up with is going to change dramatically. They're not going to put up with nonsensical stock picking from some person in some office. Like, just think about it. The notion of coming to me while I'm talking to you and I'm supposed to pick stocks to beat the market, it's preposterous. What could some guy in an office in Ottawa know more about the market than the market at large? Have you been to New York City? Have you been to Tokyo? Have you been to all these cities that have people studying it. That's why it works. And as more and more of the weak ones die off or go out of business, you're left with even harsher, stronger, better financed, better capitalized competitors to squeeze out any arbitrage there is. Yes, there will be Rentech, Renaissance Technologies. I get it. There will be outperformers. Absolutely. Too bad you can't get access. Right? So something Cliff Assis told us when he was on our podcast. Yes, there will be winners. You can't get in. Too bad for you. Right? I don't think that will change in the next decade. So we'll see. It's a super interesting time. It's not just about information. There's some people say, well, now with AI, there's no longer any information difference between a Peter Lazaroff and Joe Consumer. That may be true, but Peter can help you make better decisions about that information. It's not just about information. Information about index funds have been out there for a long time. This goes back to Markowitz in the 50s and 60s, right? Gene Fama, David Booth. Go down the list of all the luminaries of index. 16% of Canadian assets, something like that, are in index funds. You tell me there's not a whole lot of need for help here? So I think AI will help us make a difference. It'll help people discover the difference. It'll help people discover great firms like ours, like yours. What that service set will look like, it'll be incredible. It will be better. It'll be more customized. We'll know more about our clients, know more about their behavior, know more about their idiosyncrasies. That just makes us better advisors, helps give them a better experience. How that's wrapped up, we'll see.
Cameron, I wish I asked you that first. I have so much to add. I'll only say this, that with AI, the answer is only as good as the inputs. So I do feel very strongly that a good advisor or a good team of thinkers know what inputs to put in. And, the future is bright for everybody, in my opinion. There'll be pluses, there'll be minuses. We're going to have you back on, Cameron, to talk about this more, though. I feel like we only just got started here, but we're up on our time. If you don't listen to Cameron already on The Rational Reminder, you need to go subscribe to that podcast. He and his partner, Ben Felix, do great work. It influences a lot of people in the profession, as well as myself. I'll link to that in the show notes at thelongterminvestor.com. But Cameron, thank you again for joining me here today.
I appreciate it, Peter. You're a good guy, great firm, big fan of Plan Corp and all that you do, and we're great friends in the business. So thank you.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of Plan Corp and Brightplan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of Plan Corp or Brightplan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Plan Corp and Brightplan may maintain positions in the securities discussed in this podcast.